I extend a very warm and hearty welcome to all the participants and the learned speakers to this 81st webinar on CARO 2020, New and Enhanced Reporting, being organized by Corporate Professional as a part of its knowledge sharing initiative, which we started when the COVID started. So this is our 81st webinar, Anilji.
That's very...
Every Friday, 4 to 6, we are doing without any gap. As we all know, Section 143 of Companies Act require auditors of a specified class of companies to include a statement in the report on matters as may be specified. The matters on which the auditor wants to report under specified in CARO 2003 under the Companies Act 1956, and then in CARO 2015, which was substituted by CARO 2016. In 2020, MCA, after consultation with NFRA, issued new CARO 2020 in supersession of CARO 2016. The new order seeks to enhance reporting on several key areas, which includes reporting on material uncertainty around payment of liability, adequacy of internal audit, fraud and whistleblower complaints, borrowing, investment, loans and advances, loans to directors, compliance in respect of deposit acceptance, details of tangible and intangible assets, inventory and working capital, transaction with related party, adverse auditor remarks in group companies. So friends, these all things in new CARO has come. Either they have added something new or they have modified the existing one, which they proposed in last time when they introduced this. So the aim of CARO 2020 is to enhance the overall quality of reporting by the company auditors. The changes are imperative and tighten the auditors' reporting requirements. Therefore, the company's management need to be aware of the additional detail the auditor required to sign off on the balance on the reporting framework. Friends, as you are aware, that CARO 2020 is applicable for audits of financial years commencing on or after 1st April 2021. So this year, the auditor has to give report on the basis of 21-22 accounts. Today, our experts will deal with the applicability of CARO 2020, changes in CARO 2020 vis-a-vis CARO 2016, impact of new and enhanced reporting in CARO 2020. The panelists will also take up participants' questions as we always do. So first, our learned speaker Anil Sharma ji will give a presentation, and after that we will have a question answer. So anybody has any question, please write to us. Before we begin, let me just perform the pleasant duty of briefly introducing our learned speaker, those who are new. First, Mr. Anil Sharma, Chartered Accountant C. Anil Sharma is in practice for last 40 years. He is a senior partner of A. Sharma and Company, a CA firm. He is a part-time member of NFRA, an adjunct faculty within IICA, and an independent director of Keshav Sehkari Bank. He was a special invitee to MCA committee to frame CARO 2020 and a special invitee to the National Advisory Committee on Accounting Standard from 2014 to 2018. He has also been a member of ICAI Committee on Corporate Laws, Corporate Governance, and a member of Expert Advisory Committee of ICSI, besides being actively associated with various NGO and office bearer of Swadeshi Jagran Manch. He is a regular speaker in various programs of seminar. Anilji, welcome. You have come first time to our program. So
Thank you very much.
We are delighted to have you. Rajkumar ji has recommended.
पवन जी, अनिल जी क्या पहली बार आए हैं?
हाँ जी, हाँ जी.
आपने इतने इस हीरे को इतनी देर से तराशा नहीं. He is the most sought speaker in the country.
So his knowledge and the content connected to this topic is apt because he has worked this and he has given so many lectures on this topic. So we welcome Anil ji.
Thank you very much. Yeah.
Our other speakers are Dr. Rajkumar Agrawal. Rajkumar Agrawal ji is a partner in RRA Legal, Tax and Economic Law, Director Corporate Professional, and he is having a 35 years experience, and he was the chairman of Company Secretary Institute NIRC, and he was a member of Accounting Standard Board of ICAI, and recently he's the independent director of BHEL. We welcome Rajkumar ji. Then we have Amit Gupta. Amit Gupta is a FCS, insolvency professional, holds diploma in business. He is a member of Auditing Standard Board of ICSI since inception, that is 2016. He was member of Secretary Standard Board, then he was a member of Vision Committee of ICSI, and he was elected as the NIRC of ICSI since 2014. We welcome you, Amit, for this. We have another speaker, Ankit Singh, is joining us shortly. He's a head in corporate affairs and compliance in corporate profession. Last 15 years experience he has in multiple things. And he's a speaker at various forums. And he is a writer of the best-selling publication of Corporate Professional Companies Act. And he created a website and app also in Companies Act. I welcome Ankit for this program. So friends, we normally keep the program structure in such a manner that we can focus more on queries of people. So today we can understand the new CARO. It is bringing out so many changes, and earlier the law was like this, that they were mentioning that you have to report to this. Now they have given the format also. So reporting has converted into a specific format. So the chances of interpretation of different bases of keeping suitable to you is now out. So today we will discuss. First, I'll request Anil Sharma ji that you please explain what is this new in the CARO, and then I will take Rajkumar ji's input and Amit's input, and then we'll have a question answer. Today's program is up to 5:30, so we have to be crisp and brief. So over to you, Anil Sharma ji.
Yeah, thank you very much. At the outset, let me express my sincere thanks to Pawanji for giving me at least on the 81st webinar, I got the chance to be with all of you, and respected Rajji, Amit Gupta ji, and Ankit Singh ji. So it's really very my pleasure to be with you on this panel also. So friends, when we are discussing CARO 2020, I think along with that, you also have to keep in mind all the amendments which has happened in Schedule 3, because these are all linked. And those are also, you see, all the amendments in Schedule 3 are also applicable with effect from 1st April 2021 only. And along with that, there are two more amendments. One is in Rule 11 of the company's Audit and Auditor Rules 2014, because some of the points has been reporting requirement has been added there also. And all this makes a wholesome approach from the Ministry of Corporate Affairs, so that where they want management and directors, board of directors and auditors to get involved into the reporting aspects. So one very interesting aspect which I would like to add before I come to the specific sections or specific provisions of CARO, and that is that this is very first time that all the issues which auditor is commenting upon under CARO, actually before auditor does that, company's management is reporting on that. Virtually all the reporting requirements are now first expressed or given by way of note in the financial statements by the company itself or by the management. So it means the amendments which I was talking about in Schedule 3 are relating to that. So and one more very interesting background, because that will keep you guessing. You see, when this group, this particular group was created by Ministry of Corporate Affairs to suggest amendment in CARO 2016, at that time there was a team where all the regional directors in the office with the Ministry of Corporate Affairs, they were also part of that committee. And in the very first meeting, made a presentation where they were actually suggesting that auditors should comment on at least 80 points. And we were shocked that they want virtually on all aspects under the Companies Act, they want reporting from auditors. So after so much debate, then it was sorted out that some of the points has to be answered by the management only. Some of the points are to be certified by the practicing company secretaries, and rest maybe were the one which were required to be reported by the auditors in the CARO report. So these two important backgrounds. Now I have prepared a very small presentation, and I'll go through that, and then I'll try to finish it within very maybe maximum 15 minutes, and then we will take up the question answer sessions.
You have a screen.
Let me share my screen. Yeah, is it visible?
Yeah, yes, it's visible.
Okay, good. So, as Pavanji has already given the background of CARO 2020, see, if you recollect that this notification actually came way back in February 2020, and then when this notification came, the applicability was foreseen from the accounting year starting 1/4/2019 itself. In February they were issuing, and then they wanted this to be implemented from that 1920 financial year 2019-20 itself. But then a lot of representations were made, and then the ministry came out with a amendment order on 24th of March 2020, and then this applicability was shifted by 1 year. So it means then it was decided to make it applicable for the accounting year starting from 1/4/2020 onwards. But then in the month of April, we have all seen how COVID-19 has created havoc. And again, representations were made. And then the second amendment order was passed by the ministry on 17th December 2020, where the applicability was once again shifted by 1 year. So it means then it was now applicable for the accounting year starting 1st April 2021 onwards. So it means now the year which we are closing, let's say after 7-8 days or maybe 5 days, those financial statements, the auditor's report will have an annexure of CARO, that will be CARO 2020 and not CARO 2016. So with this background, let's go further. See, if we try to compare the two, you will see that earlier CARO 2016 had only 16 main clauses. But now CARO 2020 has got 21 main clauses. So this is a straight away 5 new clauses you can see here, which has been added there. But the very interesting part is that 11 main clauses have 38 sub clauses. So very large, huge reporting mandate has come to the auditors. So far as coverage is concerned, there is absolutely no change. It is applicable to foreign companies who are operating in India. Then it is not applicable to banking, insurance companies, OPC, Section 8 companies, and then specified private limited companies. And specified private limited companies are those which are fulfilling 4 conditions, which are actually not subsidiary or holding company of a public company. That is first. Second, their paid up capital and reserve and surplus together is not more than 1 crore. And this has to be seen on the balance sheet date. And their total borrowing any time during the year from any bank or financial institution at any point of time does not exceed 1 crore rupees, and which does not have total revenue as disclosed in Schedule 3, which includes revenue from discontinuing operation, does not exceed 10 crores. So this way, these four conditions are met, only then that private limited company, this CARO reporting would not be applicable, but otherwise all companies would be required to comply with that. And one very interesting point, which in fact was referred by Vijayji also in the beginning, that this is the very first time that some reporting has come on consolidated financial statement also. As you know that now, though if a company has a subsidiary company, associate or joint venture, it has to mandatorily prepare a consolidated financial statement along with its standalone financial statement. So earlier, CARO 2016 was not applicable with respect to consolidated when CARO reporting was done on consolidated financial statement. But this time, one clause has been made applicable, and I'm going to let you know the detail of that. But this was first time for CFS also, CARO has been made applicable, maybe in a very subtle and very in a small way. So now let us look at some of the important clauses which has been amended. Clause 1, para 3 has got all these 21 reporting requirements, and clause 1 of that para 3 has got 3 insertions into that as compared to CARO 2016. The very first one is whether the company is maintaining proper records of intangible assets. As you know that earlier, or in fact, in first part, the auditors are already reporting whether the company is maintaining proper records showing full particulars of its property, plant and equipment. So along with that now, intangible asset has also been brought into that reporting. And the second one is with regard to the revaluation. If during the year there is any revaluation of any class of property, plant and equipment or intangible asset, then first of all, it has to company has to ensure that the valuation is done by registered valuer, since section 247 is now operational. And then auditor is also required to report that the valuation has been done by the registered valuer. And if there's any change in the amount because of the valuation, of course there will be some change, then he has to specify the amount. And if there is a change more than 10% as compared to the earlier valuation, then each class of property, plant and equipment or intangible asset, that aggregate or separate valuation is also required to be mentioned there. Then third reporting requirement come in clause 1 is with regard to whether any proceedings have been initiated or pending against the company for holding any Benami property under the Benami Transaction Prohibition Act 1988. And if yes, then company has to properly disclose the details in its financial statement. So once the company does that, auditor is required to, as I mentioned to you, that now there is a linkage in the financial statement reporting as per Schedule 3 amendment, and then reporting by the auditors in CARO. So this is the example. First, company report whether any proceeding has been initiated or is pending, and then auditor has to comment on that whether any proceeding is there, and if not there, if it is there, that proper disclosure details has been given by the company in the financial statement. So this is these are the 3 amendments in clause 1. In clause 2, again, very important amendment has come in. First of all, this clause 2 is primarily relating to physical verification of inventory in the company. So there are two amendments, important amendments. One is earlier the word used was any material discrepancy, but now they have identified, they have made it a rule based, and that is 10% or more in the aggregate of each class of inventory. If there is any discrepancy which is more than 10% of that class of inventory, then it is required to be covered in this particular reporting. This is the first part. And second part is the auditor is now also required to express his opinion whether the coverage and procedure of verification by the management is appropriate. Earlier, this part was not there. We were just simply mentioning, reporting whether reasonable interval physical verification has been done, physical discrepancy has been noticed, and how that has been dealt with. But now they have to express their opinion whether the coverage and procedure for such verification is appropriate. So this is one important change which has come up, and it is very important. I would say, as an auditor, I can say that inventory valuation or inventory is always an area where there's a lot of scope for, manipulation, which has been seen by various authorities. So from that point of view, this is a very important one. And second amendment, which is relating to inventory only, or rather it goes beyond little inventory, and that is about the working capital limits. And if these working capital limits have been sanctioned by the company against the security of current assets, and current assets includes inventory as well as receivables and other advances which are in the normal course of business, then so this reporting, new reporting is with regard to that. And first of all, this clause is applicable only in those conditions if working capital limits are in excess of 5 crore rupees. And mind you that company would be required to report irrespective of the limit, because the same requirement is there under Schedule 3 for the company also. And now look at the provision, what has come up. They are saying that if working capital limit has been taken, has been given by the bank to the company on the basis of security of current assets, whether the quarterly return or statement filed by the company with such banks are in agreement with the books of accounts, if not, give details. Because this has been seen in, because we do bank audits also, or sometimes even stock audits also being done. So it has been noticed there that most of the time stock statements are not available. Or wherever they are available, they are either signed by someone who is not the statutory auditor of the company, or sometimes they relate to a period which is difficult to determine. Because, for example, let's say they will say 27th February is the stock, this detail is 22nd, is the information which is being provided, rather than giving it on 31st March 2000, a particular year. So this was being noticed to just to see to see that this type of malpractices are not there. Now auditor has to see that quarterly returns which has been filed with the bank, they tally the stock records which are being maintained by the company. And if there's any discrepancy, then they have to give the detail. So this is very, very important, and in fact, very, I would say, very good input for the banks, that they would see a lot of good input coming from the companies with regard to the working capital limits or CC limits which they have given to various customers. So this is the second set of amendment. Now let us go to clause 3 of para 3 of CARO. Now this here again, very, very, I would say very major amendment has come in. Now let me first read what was there earlier. whether during the year company has made investment, whether earlier the clause was whether the company has granted any loan, secured or unsecured, to companies, firms, limited liability partnership or other parties covered in the register maintained under section 189 of the Companies Act. If so, then there were 3 questions which were required to be answered. But now look at the change which has come up. First of all, in addition to loans, investment has also been brought into. Advances in the nature of loan has also been brought into. Guarantees and securities given by the company has also been brought into. So, and another very interesting amendment, which is by deletion of certain words covered in the register maintained under section 189 of the Companies Act 2013. So since these words has now been deleted, so what does it mean? That any investment made by the company, any loan or advances in the nature of loan, whether secured or unsecured, whether any guarantee or security provided to any party in companies, firms, LLPs or other parties, then this clause will trigger and auditor would be required to now report on 5. Earlier it was 5, now it is going to be 6 reporting requirement. So quickly, I'll just tell you 1 or 2. First of all, the prejudice, whether these investments made, guarantees provided, securities given, loans and advances in the nature of loan given are prejudicial to the interest of the company or not. So auditor has to give this comment. So see what was happening earlier. Loan was you can see that what is the rate of interest, what is the repayment schedule which is attached. But in the case of investment, no such terms and conditions were there. So companies were making investment route as the better route for siphoning off or diversion of funds. So to plug that, this provision has been brought in, and now auditor has to, in a broader term, has to say that whether the terms and conditions are prejudicial to the interest of the company. Another clause which has been added here is that if any loan or advances in the nature of loan has been granted, which was granted earlier, has fallen due during the year, and now has been renewed or extended for fresh loan granted to settle the overdue. So it means this was also a practice which was being noticed, and you will see that all these inputs were given by regional directors to this particular committee, that they have noticed this in various cases which are going on in NCLT. All these bank, wherever NPAs were there and there were the cases were before NCLT, these revelations came from there, that in some cases a loan was overdue, so another loan was given to pay the first amount so that the account does not become NPA. So that was that way they were shifting the sickness of the account to a subsequent period. So to control that or to plug that loophole, now this specific requirement where auditor is required to see this type of any transaction happening where overdue amount or overdue interest has been met through sanctioning of another fresh or extension of any fresh loan to settle the overdue amount. So from that point of view, this clause has been added. And there are number of cases earlier where loans or advances in the nature of loans were given, and when you ask the company that what is the term of repayment and what is when this will be repaid, the answer used to be that they are payable on demand. So now even those reportings are there. I mean, of course, now because of section 186, there cannot be any loan which is without any interest. So minimum interest has to be charged. So from that point of view, interest aspect is not relevant. But but very specifically the repayment schedule. When it is due, they say it is is repayable on demand. As and when company would require it, they will demand it, and then only you can see whether it is overdue or whether it is not, the payment is not forthcoming and all that. So that way they were again manipulating the things, some loans which were actually bad and they were not likely to come back. They were showing them as repayable on demand, and without specifying any term or period of repayment. So now that area has also been now blocked, and auditor is required to report on this aspect also. This is very interesting clause 8, which has been added into CARO reporting. It says that it happens, you see, when there is a income tax search or survey on a particular company, then sometime during that period, during that proceedings, they surrender certain assets or surrender certain income. For example, let's say if they have some cash which has not been accounted for, they surrender it as income. They sometimes stock also is being surrendered. So what was happening that sometime they were surrendering in the current year, or sometime they were surrendering in earlier years. So far as current years is concerned, they were more or less adjusting their current year's financial statement. But so far as earlier surrenders relating to earlier periods were there, those were not being properly reflected in the books of accounts. So now auditor has to, first company, again same question is there in schedule 3 also. The gist of the provision is that auditor has to verify that if any amount has been surrendered, whether as a unrecorded income in the previous year, whether they have been now properly recorded in the books of accounts during the year in which such disclosure, such surrender has been made by the company. And both in the case of cash, or in the case of inventory, or in the case of any other asset, suppose some property has been purchased, now they are surrendering. So whether that property has now been brought into the books or not. So this is the requirement under this particular clause 8. Clause 9, again relating to primarily onto the utilization of loans or relating to banking. Whether the company has been declared willful defaulter by any bank or financial institution or any other lender. Because of course it is going to be very difficult for auditor to verify this aspect. The only saving grace would be that first company is going to declare in their financial statement as required by amendment in schedule 3, whether the company is declared willful defaulter. So the background of this amendment is that lot of companies were being declared defaulter, but they were not showing that or reflecting that in their books of accounts. Similar reporting requirement are there with respect to utilization of funds which has been raised on short-term basis, but has been utilized for long-term purposes. I mean, working capital limit is being used to acquire property, plant, and equipment, because that will always create asset liability mismatch. So therefore, this reporting was thought very important, and the auditors is now required to report that. Similarly, if the company has taken any funds from any entity or person on account to meet the obligation of its subsidiaries, associate, and joint ventures, then this also is required to be reported. And on the reverse side, if the company has raised any loan during the year on the basis of pledging the security held in subsidiaries, joint ventures, or associate company, then that would also require to be now reported. It means that asset is there in the subsidiary company, and that is being used by the company to raise loan in the holding company. So this type of information reporting requirement is going to be there under clause 9. clause, clause 11. This is regarding fraud reporting. This earlier the reporting, fraud reporting was, the clause was whether any fraud by the company or any fraud on the company by its officers or employees. It was restricted. Fraud reporting was restricted to that only. So the first amendment which has come up is that they have removed these words by its officers or employees. So any kind of fraud by the company or any fraud on the company which has been reported, which has been noticed or reported during the year, is now required to be disclosed by the auditor in its CARO reporting. And secondly, if under section 143.12, if auditor has filed any report which is again relating to fraud or suspected fraud happening in the company through filing form ADT 4 with the Ministry of Corporate Affairs under Rule 13 of the company's audit and auditor rules, then that auditor has done that. That fact is required to be given in this CARO reporting also. So what was happening? Reporting was not there by the auditors, but it was not coming forth to the public, who is actually the stakeholder, that what has happened in the company. So with this, now any fraud reporting by the auditor directly to the ministry will become reporting requirement in the relating to general purpose financial statement also. Similarly, whether the auditor has considered whistleblower complaints, if any, received during the year by the company. So if wherever there is a whistleblower mechanism, whether it is because of section 177 or because our company has set up any voluntarily they have set up a whistleblower mechanism within the company, the auditor is now required to see, first of all the complaints, how they have been settled, to whom they are being addressed, and how they are being addressed, and what is the pending matter, and why the delay. All those aspects are now to be, the only reporting requirement is at least now auditor has to see that whatever complaints has been has received by the company have been considered. But practically it will not be restricted to that. Suppose there is a complaint which is addressing to a very important issue which may vitiate the true and fair view of the company. Let's say this type of complaint is there. So even though it is a very small reporting in CARO, but it will have a very major impact in our main reporting under section 143, subsection 2 or 3, wherever that matter may link to. So from that point of view, it's a very important amendment in reporting requirement in CARO. Clause 14, which has been brought in, is Pavanji was also mentioning about it, is about the internal audit system. So what was happening that companies were just having some internal audit system, because as per the requirement, it's between the internal auditor and the management and the board of directors to look into their terms of reference and their scope of internal audit. But now auditor is required to report whether the internal audit system is commensurate with the size and nature of its business. So suppose if internal audit has not been, the company has not been subject, a particular area of the company which is important has not been subject to internal audit, then auditor is going to report under this particular clause that the internal audit system is not commensurate. And another related amendment reporting requirement is that all the reports of internal auditor are now, earlier also it was being considered, but now he has to very specifically report whether the reports of internal auditors were considered by him while preparing his, while giving his report on the financial statement. Now, 2 or 3 very important fresh clauses which has been inserted. So clause 16 was the earlier one, which was on the whether the company is a non-banking financial company, or if yes, then whether it has taken the registration. But along with that, two more reporting. One is onto the housing financing activity, because now non-banking financial companies of which are housing financing companies, they are also now under RBI regulation. Earlier they were under National Banking Housing Bank, National Housing Bank. But since now they have brought it under RBI, so therefore this reporting has been brought in. Similarly, reporting with regard to core investment company. As you know, that core investment company below 100 crores is not required to get itself registered. So now if somebody is claiming that it is a core investment company and is not registering it, whether all the criteria has been met by the company or not, that is required to be reported by the auditors under this particular clause. One more clause has been added. This is about the earlier we used to even before the CARO 2016, there was a reporting with regard to sickness of the company. So we are not, the auditor is not required to report on the sickness, but the features of sickness, whether the company has incurred cash losses in the financial year and in the immediately preceding financial year, then it has to state the amount of cash losses which it has incurred. So again, this is a very interesting data which would be reporting, which would be available with regard to health of the company. Now, I mean, in the last few years, a couple of years, you have seen a particular phenomena where some statutory auditors were resigning from the companies. So now, and they were saying from personal reasons or due to unavoidable circumstances and all that. And then there were a lot of inquiries why they are resigning. Is there some hanky-panky in the company's business or something? So now a new clause has been added, keeping that in that background, that if statutory auditor has resigned in a particular company and new auditor has been appointed, he has to ensure that whatever issues, objections, or concerns which has been raised by the outgoing auditors, they are being properly taken care of while drafting his report on the company. So it means you are not removing the auditor since he was about to qualify the report. So from that point of view, this clause becomes interesting addition. And finally, one area where auditors were always shying away, and that was whether the company is financially viable in short term. So we were saying that the argument which auditors were always taking before ministry was that we are giving a true and fair view, which is a broader term, and we cannot just pinpoint on financial viability of the company. And to resolve that, what has been happened that 3-4 amendment has been brought into Schedule 3. Company is now required to report on 11 financial ratios. Company is required to give aging of its trade receivables, aging of its trade payables, and then along with that, a lot of other information about the future activities is available to the auditors. So now the ministry requires the auditor, based on financial ratios, based on aging of receivables and payables, which determines actually the cash flow of the company for a shorter term, whether in his opinion any material uncertainty exists on the date of audit report that company is capable of meeting its liability existing at the date of balance sheet as and when they fall due within a period of 1 year from the balance sheet date. So whether in next 1 year, whether based on this data, you have to express your opinion that there is no material uncertainty exists, that company would not be in a position to meet these liabilities. So these were Yeah, I think this one more clause. Yeah, this is okay. This is also important. Clause 20. This is relating to CSR expenditure. As you know, that section 135 has been extensively amended. So to cover that, and then the section requires that if company does not spend, then and it is not relating to any ongoing project, then they have to transfer that fund in the within next 6 months to the specified fund as mentioned in Schedule 7. So auditor has to ensure that company has done that. And similarly, in the case of ongoing project, which can only extend up to 3 years, and still some amount, even after 3 years, some amount remains unspent, then again, audit company is required to put that into special, into that Schedule 7 defined fund that is required to be given. And then if there is an ongoing project and company is required to put that money, which is specifically earmarked for ongoing project, into a special account. So that reporting is also that requirement of subsection 6 of section 135. Auditor is also required to report whether the company has complied with that also. And finally, the last one, which is clause 21. As I mentioned to you, there is one clause which is applicable to consolidated financial statement. Now it says that if let's say consolidated financial statement consists of holding companies, and then subsidiary company, associate, and joint venture, if any of these standalone financial statement has got any comment by the auditor in CARO, only that qualified reporting will come as a reporting in the CFS also. So, Pawanji, these were the amendments I could quickly place before the audience. Now let's take the questions and go further.
Thank you very much, Anilji, for giving the entire journey of this new CARO. I have so many questions relating to this that I will ask you, and I have already received 20 questions, so they will do it.
Sure.
Now I will request, there are two speakers, Amit Gupta and R.K. Agrawal ji. Now Amit ji and R.K. Agrawal ji, I will request whatever Anil ji has mentioned, you just raise your quick view, then we will go for question answer. So 5 minutes you can tell that what is the impact and what are the problems in this, if there any issue will erupt due to these changes. Amit Gupta first, then R.K. Agrawal ji will join us.
Thank you, sir. I think sir has covered very nicely the entire gamut of changes what CARO 2020 has brought in. I have some thoughts while sir was explaining the provisions. So as I understand, with regard to applicability, there is no change in the applicability parameter from CARO 2016 vis-a-vis CARO 2020, as I understand. However, because the definition of small companies has undergone change with effect from 1st April 2021. So there will be lot of small companies which will be now eligible for exemption from reporting in CARO. And the new definition of a small company says that the companies which are not having paid up share capital exceeding rupees 2 crore or turnover exceeding 20 crore, they will be considered as a small company. So do you agree that these smaller companies, though because there is a separate clause in regard to CARO, which is also dealing with the private limited companies, and there may be a conflict between these two clauses, one which is specifically dealing with the private limited companies which are not subsidiary or holding company of a public limited company and having capital and reserves not exceeding rupees 1 crore and not having borrowing in excess of 1 crore and certain other parameters. So these are one set of companies which are sought to be exempted. In addition, they have exempted the smaller companies. So my understanding is that both benefit will be available. I just wanted a confirmation from your side, because these are providing two separate limits. So that's where the
yeah, Amiji, absolutely no doubt in it, and that you have very rightly seen it that since there is a specific exemption to small company, and any company which is fulfilling the criteria of a small company would be exempt from reporting under CARO. But the other company, which is specified private limited companies, which I just mentioned, it is for those who are not covered in any other category, which are specifically there. For example, one-person company. If one-person company will also be a private limited company, so again it will be out. Similarly, a small company and those that would also be out of. Then you would not be going to private limited company criteria at all, so long as it is a one-person company or a small company as defined in clause 62 or 85 of section 2.
So I just need to qualify into any one of the parameter, and I would be eligible to take the exemption.
Absolutely.
Second point, as you covered rightly in respect of consolidated financial statement, that law is like, as I understand, is that while auditor will be giving his report in respect of holding company, so up till now the holding company CARO report was not including any comments in respect of qualifications in the subsidiary company CARO report.
Right.
Now, only change that has happened perhaps is you are not required to include anything and everything in CARO report of holding company. Only thing that you are required to include is the qualifications what the auditor has given in respect of CARO report of a subsidiary company.
I mean, earlier there was no reporting at all.
Yeah.
CARO reporting was not there at all for CFS. Now they have brought in that only if there are qualifications, then you attach this. That's all.
So you mean to say if a company, holding company, was to give a report, then CARO report was not attached at all there?
It was not there earlier.
Okay.
It's a new requirement.
So now new requirement is also limited only to the qualifications of a subsidiary company.
Absolutely. Or all any of these, any qualification in all those entities which are considered as part of the group. CFS is group. So any entity which is part of that group, if the auditor has any qualification under CARO of that particular group entity, then CFS would also include a reporting.
So, but my point is that it will be limited only to highlight that.
Absolutely.
Highlight that qualification or adverse.
That right.
Yeah. Then there are a lot of changes which you indicated with respect of immovable property also. And I have a bit of dilemma. I don't know how to express it. But while I read the provisions of section 187(1) of the Companies Act, which mandates that all investments made or held by a company in a property, security or other assets shall be made and held by company in its own name.
Right.
So that means company at all cannot hold any property or investment in any other name.
Right.
In section 187 itself, they have created a carve out also to facilitate the incorporation of a wholly owned subsidiary. That is the only exception that has been carved out. Now, while I read the provisions of CARO 2020, which requires the auditor to give a comment, and also Schedule 3 has also been amended, which mandates a company to make a declaration that all the immovable property which are disclosed in the financial statement are held in the name of the company.
Right.
It also goes on to say that details of immovable property which are disclosed in the financial statement but are not held in the name of the company shall also be disclosed.
Right.
So I fail to reconcile as to what are they trying to say, that there is a leeway or there is a room that company can afford to hold the property not in its own name, because
Okay.
because the law is mandating that you report on that. An auditor is also supposed to make a reporting on that. Means how to, because 187 clearly says that you cannot hold.
Yeah. See, that's why this Benami Property Act has come into play. So first of all, let me quickly explain you that immovable property, so far as from accounting point of view or from accounting standard point of view is concerned, it can appear in two places in the financial statement. One is under the head property, plant and equipment. When the immovable property is being used by the company for carrying out its principal business, then it will be classified under property, plant and equipment head. And if that immovable property is acquired by the company but the intention is not to use it for the business but to earn capital gain or let's say rental income out of it, then it is shown under the head investment. So investment, immovable property, investment, there land and building is also there. And the third category can also emerge, and that is called asset which are held for sale. They have been discarded from the actual use. And because I'll explain you that what happened in a one particular company, they have purchased a one particular land or building is there, but now they cannot operate from there because of, let's say, some restrictions, local restrictions. So what they have now, they have now removed it from their property, plant and equipment, and they have parked in the financial statement, not under investment, under current assets, which is available for sale. So now they are looking for that, they are going to sell that particular property. So this way, at three places it can come. And one more important point, that in number of cases, immovable property can also be acquired through lease. So what happened earlier, even in lease case, what happens if there's a lease, the title deed comes only after the entire lease money has been paid. So what was since this clarification was not very clearly defined earlier, so company auditors were reporting all lease transactions under this particular head. So now what they have done very cleverly or very clearly, they have mentioned other than those lease property held under lease, which are subject to proper lease agreements. So it means they know that in the case of lease agreement, the property will not be in the name of the company, so it is not required to be reported here by the auditor. So only, and then the last point which you mentioned about the whether the company can hold property in the name of any other person. So that is a very common case where when these they call it Benami Property Act. So if you look at the reporting requirement under that Benami property, that since when it is held, in whose name it is held, and why it is being held in that name. So all that information, and whether the amount is appearing in the books of accounts or not, even that information is required to be reported. So I would say that regulator has visualized all situations where when the company would be considered as owning that property, it may not be in company's name, it may be somebody else's name. Even the funds are not being reflected in the books of accounts. It has been paid, let's say, out of books, and let's say the black money has been paid for that. But it is this building belongs to a particular person. So that way, I think I don't know whether I would be in a position to remove your doubt.
Just a small follow-up question. As we see in a common word, when we do a transaction, how it happens. We do the agreement of sale, and then the property is coming to the, maybe the title registration in the name of a company is a long process. Maybe not necessary that your title will be registered at the time of payment. So
Yeah.
maybe in a financial year ending on 31st March 2022, you have paid the money. So maybe title is not coming to you. So
Right.
maybe during that temporary or interregnum period, you are holding the property in the name of someone else. Maybe the
Yes.
other person is a buyer. So if
That's
the
right.
intention is only to cover these type of transactions, or the intention is because someone should not interpret that by asking these type of questions in the CARO reporting, law is not getting or amended to provide you a leeway to hold the property in the name of someone else also.
No, I don't think that. You should not stretch it to that extent. Because see, now rather what they are doing through that report, any proceedings or any proceeding initiated or pending against the company with regard to Benami property. So by bringing that, in fact, they are bringing other properties also. If those are not in the books of accounts of the company, they are even reporting, they are bringing that also into the reporting. And very interesting point, which I was, when we discussed this, I think I would like to give you the background. So when we asked that how auditor will know that whether this property is Benami is there or not, and first of all, why a company would in its financial statement will disclose that they are holding such property under Benami Property Act. So they say they were very, clever. They say if company gives a wrong statement or they suppress any fact, then at a later stage, we would be in a position to invoke section 447. So company will not be in a position to really take that kind of liberty. So once company has given, and then if sometimes now this what has happened, audits has also become now, auditor has to gather various information, not only from the financial books of accounts. Now some information has to be gathered from other sources, which may include say print media or something like that. So that is the point. From auditors will have definitely. I'll give you another example. Company has said no. But now when we look at the professional charges paid, so we see a particular bill paid to a particular lawyer that I am fighting such and such case under Benami Property Act. So that way, this is the additional work which auditor has to now perform to look to give this kind of reporting.
Okay, Anilji. Now R.K. Agarwalji has come.
Yes.
And I have received around 23 questions also.
Yeah.
So, Anilji, your quick view on the entire thing and certain aspects, because Anilji has very lucidly explained the entire thing, what is there. In your opinion, the new CARO, what is your point of view? How the audit, as an auditor, you are thinking and you are handling, and how this will impact change in the corporate world?
Pavanji, so far as CARO reporting is concerned, if we see, there have been probably 4 amendments. Every 5 or 7 years after, there is an amendment in the CARO report. And the objective of the regulator is that CARO report should be made applicable in such a manner. There are 3-4 main objectives which they want to achieve. First of all, if there is any diversion of funds from the company or for the purpose for which the funds are deployed, that should be reported. The financial health of the company, if it is deteriorating, there should be early signals which should be reported so that the investors or regulators may take note of it. Then to ensure that the security and safety of the assets remain there. If it is hampered, then there is early reporting of that. I mean, from that point of view, main audit report hardly gives any qualifications. It is the CARO report where so many points have been covered, and with every amendment, 3-4 new issues are taken up, which are of great significance. And it is in the interest of the companies that this audit report is covering so much of point. And if there are any qualifications or adverse remarks coming in CARO report, the management should take it seriously and try to resolve those issues. It is not that auditors are, it is a duty of only the auditors that they will report it. Rather, it is for the management. Therefore, now in Schedule 3, management has also been held responsible first, that they will report that what are the deviations, what are the qualifications, what are the restrictions from the CARO requirement which you are not following. Two important things which I will just mention because I know there is a shortage of time. That one is regarding the bank statement. It has been a matter of so much of dispute under the Income Tax Act that you give some audit, some stock statement and debtors statement to the bankers of any other amount or higher amount to avail the credit facilities. But when you finalize the balance sheet, you give the stock statement of the lower amount, which may be correct also. I mean, the actual amount. But either you are defrauding with the tax department or you are defrauding with the bankers. Both of us, these are wrong. So far, there was no reporting on this issue. Even the decisions of the courts were of divergent nature regarding the addition which can be made if there is a difference in two stock statements. But now when reporting is coming, management will be not in a position to give different statements to the bankers and the tax department or for the purpose of financial statement. So this is a very welcome change. And again, second point, very important, which has been brought, the declaration of undisclosed income. A company is searched, they are making a declaration of undisclosed income, they are confessing, they are admitting that they have earned the income out of the books. And still they don't report in the financial statement. Only for the tax purpose, in the computation of income, it is reflected, it is shown, income is shown, and tax is paid, but not introduced in the financial statement. Because when you introduce in the financial statement, other consequences may follow. That why it has become so. There may be other agencies, other departments which may be active on this issue. And now government want coordinated investigation, not only from the tax department point of view, but from the department point of view of all the departments. So when there would be reporting and there will be compulsory accounting of any disclosed income which has been declared in the financial statement, then other departments, it may be GST, it may be customs, it may be Benami, it may be ED, whosoever it may be bankers, they will also take note of it, and consequential impacts would be there. So now the time has come that businessman has to follow the corporate governance, follow the ethics and principles very clearly. Otherwise, whenever any kind of these tactics are adopted, they may be caught, and therefore the reporting requirements are getting increased. Now the point will come when you are making declaration of undisclosed income of earlier years, how this will be accounted in the books of accounts. If it is of the current year, no problem, you can show through P&L account in the current year. But it is of the earlier years, then whether you can take directly to the reserves or it will have to be routed through the P&L account. To my opinion, it has to be routed to the P&L account as prior period's income. And when you show it like this, then whether MAT would be applicable or not, again, another question may arise. There may be so many issues from the tax angle also, which may come into play when these transactions would be captured in the financial statements. And not only the tax point of view, rather other agencies may also be active so far as this part is concerned. So we will discuss other issues in the question answer. I don't want to hold you back, Pawanji. We can open the question answer, then we will keep on discussing.
Okay. So thank you.
Sir, I have a related question to what R.K. Agarwal sir has mentioned with regard to the undisclosed income. Suppose there is a company which has received the share capital, which was from maybe some other bogus entities, and income tax department during the year 2021 has made some additions and considered it as an income, and the company has paid the taxes on the same also. Now, as per this current reporting of CARO, do you think a company would be required to change the nomenclature of share capital to income and shift the capital to its income? Because in the income tax law, it has been taxed as a income only. What is the impact of this CARO on this particular income tax assessment order that the company has received? There can be two type of changes. One change is with regard to undisclosed income at all. So if there is an income which has not been disclosed at all, law says that it has now to be disclosed as per the new CARO. There can be change in the nomenclature also. So do you think that where the income has been added because of the change in the nomenclature, the change in the books of accounts will be also be required?
But this is a very controversial issue, and a lot of discussion, debates have taken place at number of forums on this issue, but no, concrete solution which is beneficial from the point of view of the companies both ways has been found. But if we see the true character of declaration, it means company is confessing that this was my income, which has been introduced as share capital in a bogus manner, in disguise. It means that correctly, if accounting is to be made, share capital, it cannot be in the nature of share capital. It has to go to the incomes, either in reserves and surplus or through P&L account. But that means that here comes the violation of the Companies Act, that you have issued shares to the fictitious persons. So whatever the consequences of the Companies Act are concerned, those will follow necessarily. Those will follow because you have issued share capital to fictitious persons, though it was the funds and income of the companies itself. So therefore, to find a way of which may absolve the company from the prosecution in the Companies Act as well as in the Income Tax Act, may not be possible. May not be possible. So therefore, these kind of instruments which used to be adopted by the dubious companies, now government is trying to catch hold from all angles, from all corners, so that at some or the other place they are caught and they don't keep on doing these kind of practices.
Okay, RK, thank you very much. Now I have to ask various questions because we have 40 questions with us, so we have to do it. And I will start rapid round after this.
जी आप टेंशन मत करो, हम 5:30 नहीं 6 बजे तक बैठे हैं, आप सारे क्वेश्चन कवर करो.
Okay. So Anil, first question: whether CARO 2020 is applicable on private companies?
Yes,
yes, it is applicable, but not to specified private limited companies, as I explained.
Okay. RKG, what precaution need to be followed by the company apart from auditor?
Whatever adverse reporting auditors are doing, it is the act of the company. Auditors are only reporting. So the precaution to the company is that they don't act adversely. They don't act against the law. They don't act against the standard practices or against the requirement which is in their interest to keep the financial health of the company intact.
Okay.
There should not be any.
I would like to add what Raji is saying. You see, one point we must keep in mind that let us not think that CARO reporting is always going to be a secluded or a reporting in silo. It is, if there is any item reported in CARO which has got an impact on true and fair view of the state of affairs of the company or the profitability of the company, then auditor is duty bound to report that in its main report also. It's not that CARO is only a separate report and has nothing to do with the main report.
Okay. Amit, any non-compliance of CARO requirement, material or otherwise, that is delay in contribution of ESIC, lead to qualified audit report? If so, whether the board has to address the non-compliance in the board report with explanation?
Yes, absolutely. And now the scope of reporting of delays in the statutory dues has been expanded. in comparison to the previous scope under CARO 2016, and wherever the adverse remarks are coming, it will be considered as a qualification, and the board is required to give a necessary justification for the same.
Okay, Anilji, the condition of exemption states authorized capital is less than and turnover is less than. Both conditions have to be satisfied, or either one, since and is in between the two conditions.
Yeah, all the conditions has to be met. It means that the company should not be should not be exceeding any of these four. All the four he has to be below all the four.
Okay. RKG.
And all the three, and one is of course the subsidiary and holding structure.
RKG, agricultural land cannot be purchased by company. Companies do purchase agricultural land in director's name, conversion, and later use for industrial or commercial use. Whether this falls under the mischief of Benami Act?
No, from where you are taking that agricultural land cannot be purchased by the companies?
Oh, okay, for presume somebody has purchased the land not in the company.
In some of the states there are restrictions. These are state laws actually. So some of the states have put the restriction, not in all states.
Generally, agricultural lands are purchased by the companies. I am not aware that in which state it is not permitted, but corporate structure is used for the purpose of purchasing agricultural lands. Now, Pawanji, what is the query?
The query is, suppose the land you have purchased, you forget agricultural land, you land and purchase, not by the company's money in the name of directors.
No, because now you cannot purchase the name in somebody else's name, because Benami Act would be applicable. But under the Benami Act, for the corporates, if you are holding the asset in trust, there is certain exemption. So if you are meeting all the requirement of to fall in that exemption, only then a company can hold the asset in the name of some other person as trustee of the asset. So those requirements are required to be fulfilled. Otherwise, you will be caught within the ambit of the Benami Act.
Okay.
I will just add to what RK sir has added. By law, section 187(1) is also into picture, which says that clearly company cannot hold the property in the name of anyone else. That is a rule. Exception has been given in the CARO report. Wherever you are not holding, you have to give a reporting now. Earlier it was not coming. Now in the schedule 3 also you are required to report. Wherever you have a justified reason that why you are not holding the property in the name of the company, maybe you are holding the property in the name of director, ultimately it will come into the name of the company. It is an interregnum arrangement. Then you will give a justification in your schedule 3, and auditor will also make a comment. I think I will read it that way.
Amit, I would like to differ with you a little bit on this. So if we read section 187 once again,
sir.
See, subsection 1 and 2 are different. Subsection 1 is talking about property, security, and other assets, all. Whereas the proviso, when you come to the proviso part of the subsection 1, it is not only talking about shares. You were mentioning that whether this can be considered as that now, can we say that now somehow it is a indirect permission. So I don't think it is only 187 requires that it is giving exemption only, and then subsection 2 comes in. Subsection 1 proviso has given that in the case of shares of subsidiary company, because in any case if you are holding 100% subsidiary, wholly owned subsidiary company, you have to have, if it is private limited, you have to have another one more name. Or if it is a limited, you have to have 6 more names. So then you create nominees. So it is just addressing to that. It is not giving any indirect benefit to companies to acquire property in Benami, in other names. That is my interpretation.
Yeah, I'm also saying the same thing.
Amit is also saying the same thing.
I'm also saying the same thing.
Yeah. Anilji, whether the internal auditor report was considered by the statutory auditor, what will be required under this and how it can be complied.
Yes, sir. Sorry, I couldn't get your point.
Whether the internal auditor report work
Okay. Yeah.
the auditor
Yeah.
required under this and how it can be complied. Because yeah.
You see, first of all, the entire statutory audit, as we all know that the very first thing which they do is they assess the internal control mechanism of the company. What is the system which they have put in place? And then based on that, they do some tests and ensure that all the checks and balances are there, they are being operated, and they are efficiently functioning. If not, then they enhance, they increase their checking by way of their audit, in their audit program, whatever they want to do. They cover the areas that if they feel that there is a still higher risk that there may be some material misstatement, they increase the scope of their working. So internal audit is nothing but a very important aspect of internal control. So if internal audit is weak, auditor has the very first thing, auditor, when it is assessing the internal control mechanism of the company, if internal audit is, let's say the scope of the internal audit is weak, they have not covered some certain areas, or sometimes the reporting is to a very low person in the hierarchy, and they don't know what action are being taken. All these factors make the auditor ensure that he has to, while framing his verification, checking, or audit program, he has to expand the area so that by presuming that this area has not been done by the internal auditor, and accordingly he has to do that part also as part of his exercise.
Pawanji, I may just add here that in fact, internal auditor we should take as extended arm of the statutory auditor. In the sense that somebody has also done the internal audit, and any adverse comments, any qualifications, any adverse remarks which are incorporated in their report, statutory auditors are duty bound to consider them and see whether these remarks or adverse comments affect their reporting also, either in the main report or in the audit report. Because those observations, if they can re-verify, recheck those observations, and I will say not only the internal auditor report, rather report of any auditor. It may be cost auditor, it may be special auditor, it may be some other investigation team. Then whoever has done the investigation or audit, and any material is available on that, all material should be considered by the statutory auditors while forming their opinion regarding the financial statements.
So you are on mute.
Pawanji, you are mute.
So CARO and statutory auditor both have to be different, number one.
No. CARO is given by the statutory auditors.
So then who will see this? If CARO is given by the statutory auditor, then who will, because he is given, because what is happening, the statutory auditor has to consider whatever written in the CARO also, and the same person is giving. But we have seen in so many companies that some companies doing manipulation and statutory auditor is not reporting.
That's why we are saying if that manipulation has been reported by some other auditor, statutory auditor should be a privy, and they should look into those reports and form their opinion regarding the statutory audit for giving in the main report or CARO report whatever the comments they want to give.
I think that is what has been mandated. If I understand correctly, CARO 2020 has mandated the statutory auditor to take due cognizance of the report of internal auditor.
Yes.
He is now duty bound, which was not earlier the case.
Yes.
Now, I have a specific question to Anil sir in this regard, which I have not understood, because the CARO 2020 says in respect of all companies on which the CARO 2020 is applicable, with regard to this particular provision as to whether the company has internal audit system commensurate with the size and nature of business. Now, whether internal audit is applicable or not, that is guided by section 138 of the
Right.
Companies Act. Now, may be possible that my company is falling in the radar of CARO, but is not falling in the radar of 138. What the auditor will report?
Yes. Okay, I'll answer you. First of all, even if it is 138, if you look at the particular section, it says that the scope of internal audit will be determined by the management, by the board of directors, and the internal auditor, right?
Correct.
So one issue comes here. Suppose they decide that certain areas are not to be touched by the internal auditor. So it means then statutory auditor will see that this area has not been addressed by the internal auditor. I have to take care of it. This is one part. Now coming to the second part where section 138 is not applicable. As I was explaining earlier, that internal, any company, whatever, whether small or big, they have to have certain checks and balances. How a company, whether it is by a single person who owns husband, wife is maintaining a company, still they have some checks and balances. And internal audit does not mean that you have to have a full setup of outsiders, or maybe you have to appoint an internal auditor. It depends on the size of the company. So each company has got some internal controls. They have how, let's say for example, who will make cash payments, who will take care of the cash. Suppose this is the area. Every company will have, whether it's small or big. This is, and if internal, and then internal audit is always, what is internal audit? Internal audit is that somebody has done it, and within the organization, you are putting someone to check it. It is only maker and checker kind of concept. So if that concept is not there in a company, which even where the 138 is not applicable, auditor has to consider it and has to report if he is not satisfied.
So we can have a takeaway that the companies on which CARO is applicable and 138 though is not applicable, they need to have a formal system of internal control which is commensurate with this.
We have for auditors, we have standard on auditing, and the standard on auditing, the very first assessing the internal control, that is the very first auditing standard which he has to follow, and which covers this area which you are telling.
I can just add here, Amit ji, पहली चीज तो internal control and internal audit are two different things.
Two different things.
Internal control system means that management is following a system where automatic checks and balances are there, where the system is robust enough to there cannot be any kind of leakage or manipulation. So this is another requirement. But this clause which is requiring the efficacy of the internal audit, here there are two requirements. First of all, statutory auditor has to report regarding the efficacy of the internal audit system, if it is applicable in the company, whether it is commensurate with the size and nature of business of the company or not. So what you are saying that in 138 में requirement नहीं है, उसके बाद भी अगर किसी ने नहीं रखा हुआ है तो कोई प्रॉब्लम नहीं है, लेकिन ऑडिटर को लगता है कि सिस्टम होना चाहिए या 138 में रिक्वायरमेंट है और उन्होंने वो सिस्टम बना लिया, लेकिन जैसे अनिल जी ने कहा दे कैन गिव द मैंडेट कि भाई कि आप केवल इतना चेकिंग कर लो, एंड स्टैट्यूटरी ऑडिट फील्स कि दिस मच इज नॉट सफिशिएंट, आपने केवल इन्वेंटरी चेक करा लिया और कुछ चेक नहीं कराया, दिस इज नॉट सफिशिएंट, so they can give the remarks that it is not efficient enough internal audit system which has been put in place. This is one thing, efficacy. And secondly is, if there are any adverse remarks which have been given by the internal auditors, statutory auditors are duty bound to consider those remarks to form their opinion while reporting in 220 in main report or in CARO report. If in spite of the observations by other auditors, other investigation agencies, they are not taking note of it and not making part of their report, if it is required to be made, then there is a gross negligence on their part.
Okay, now rapid drive to start because we are exceeding time. So friends, now what question I will ask to the person, nobody will cross do, and he has to give a very quick answer. Amit ji, As per section 447, punishment for fraud is applicable on the natural person who has done the fraud. Under CARO 2020, it indicates about any fraud by the company. Company is an artificial person. How can be reported for fraud? Quick answer.
The principle of vicarious liability of criminal offenses will apply.
Okay, RK, does working capital include VG limits, non-fund based?
Does working capital
Include VG limits, non-fund based?
no? Non-fund based limit is in security or in guarantee, not in working capital limit.
Okay. Well, Anilji, where the company has provided bank guarantee, will these be required to be reported?
Bank guarantees are required to be reported under contingent liability.
Okay.
By way of note in the financial statement.
Amit, there is a audit committee and such other mechanism established in the company to consider the whistleblower complaints. What does the word auditor whether has considered means? Are they common or sit on the judgment of the decision taken already, or has to be expressed his opinion on the decision taken?
I think the scope of statutory auditor is limited to verify whether the whistleblower mechanism or vigil mechanism is in place or not. If that is in place, they will not sit into the judgment of audit committee whether the judgment was right or wrong.
Okay.
That is not the scope.
Okay, Anilji, does it mean that unless subsidiary financials are audited, audit of holding company will be held up, as the auditor of holding company would want to ensure there is no qualification in audit report of subsidiary company?
It's a very interesting question. See, then he has to qualify in his report that, see, first of all, auditor will do two audits. One is the standalone financial statement of the holding company, and the second is audit of the consolidated financial statement. So far as standalone financial statements are concerned, so clause 21, which I just mentioned, that is not applicable there. And he would be able to give all the 12 reporting in the standalone financial statement, and his work will not hamper. It's only when he would be carrying out the audit of a consolidated financial statement, then audit of other subsidiaries and audited accounts would be required. And in any case, if those are not, then he has to qualify his report that this is the situation.
Okay. RKG, we have done the revaluation as per Ind AS for land and building, but not for other plant and machinery. Thus, are we required to take a registered valuation for other plant and machinery?
No, because if you are doing revaluation only of land and building, because for a class of asset, revaluation can be done. It is not necessary that revaluation is required to be done for the entire property, plant and equipments. So if you are doing only for a class of assets, it's okay.
Okay. Anilji, how an auditor can determine whether the investment or loan are prejudicial to the interest of the company? Auditors are entering into the shoes of the management.
See, auditor is not commenting on the initial investment that is being made, but see, over a period, see, if let's say investment, there are so many factors which he has to consider. Why investment is being made, and see, if it is, let's say, additional investment, what is the reason why this additional investment is being made? So there can be so many factors which he has to consider before giving a final verdict that these are not prejudicial to the interest of the company. The main criteria is that investment which has been made by the company is secured. So long as he feels that amount has been invested in a project which is supported by documentary evidences that this is required, and there is no hanky-panky in the sense that there's no, it doesn't look like there's a diversion of funds or siphoning of funds, then he has no problem. But number of cases it has happened that this route has been used for siphoning of funds or diversion of funds. Look at the lot of real estate businesses where business houses has done that. So there he has to qualify that this is not prejudicial to the interest of the company.
Like Anilji, in IPO, there is a clause that why you require fund. And suppose the company has surplus fund and then they are going for IPO, then the question is why you require fund. So if the company has sufficient cash flow and then they are taking a loan and then giving to some other person, so that is an indication.
Yeah, exactly.
Amit, in case of any of the clause of CARO are not applicable, the auditors have still to report that the relevant clause is not applicable. What about the reporting by the companies on various clause of additional regulatory information in Schedule 3 if there is nothing to be reported?
I think in Schedule 3 also we have seen the reporting pattern where if at all any particular clause is not applicable, the management is specifying that these requirements are not applicable. So the standard practice in a similar manner will be followed by the company and the auditor both.
Okay. RKG, as per clause 1D, it is mandatory for the company to revalue PPE or intangible asset during the year, or it is applicable only if any such revaluation has been done?
Only if revaluation has been done. It is not mandatory.
Okay. Amit, why compulsory internal audit should be kept so high when almost all the IBC cases before NCLT are fraud cases where there is no mandatory internal audit?
Internal audit requirement, if you feel that company can voluntarily choose, that's one part of it. Why law should mandate? Because I don't see that there is any reason internal audit limit whatever has been prescribed so far by the government, that you should be a listed entity, and if you are an unlisted company, then paid up capital of 50 crore or turnover of 200 crore. So an outstanding borrowing of 100 crore, which seems to be reasonable as far as my understanding goes. But yes, no audit can be checks and put a check on whether the company will remain solvent. In fact, I was coming to that particular clause itself, because in CARO, now there is a requirement that you have to make a comment that the company is in a position to meet its all liabilities. That is, company is going to be solvent, is going to be remaining solvent. I think that's addition in the Schedule 3. Perhaps Anil sir can confirm. So point is not that no audit and no diligence can let your company remain solvent. Solvency is something related to business. Wherever there is a business, the risk is there. So if your business fails, the company can go into insolvency. So audit is only to find out whether the reflection in the financial statement are giving true and correct fair view of the state of affairs of the company or not. That's it.
Anilji, whether outstanding at the year end falls under contingent liability?
Yes.
Okay. RKG, passenger vehicle cars purchased by company on loan basis in the name of directors, EMI are paid by the company.
Again, the same situation will come. Whether you are complying with the requirement which is given in the Benami Act or under the Companies Act, where a company can hold or get the registration of an asset in the name of director as a trustee. There are requirements. If you are following them, if you are complying with them, then it is possible.
Okay. RK, whether income declared to income tax department because of difference of opinion need to alter accounts, change auditor's report?
Yeah, now this is a question of facts. It will depend that what kind of difference of opinion is there and why declaration has been made. If declaration has been made due to pressure without any details or without any reasoning, then it has to be retracted by the company at a later stage. So I mean, this question cannot be answered because this is a question of facts. And depending upon the facts, we will have to take a decision how the declared income at all, whether it is required to be introduced in the books of accounts or not.
Okay. Anilji, what is the status in collaboration of property development, which sometimes takes years?
Collaboration of property?
What will be the status in collaboration of property development, which takes some time, it takes too much time? I think the question.
So far as let me tackle this. collaboration agreement, joint development agreements, maybe in the nature where it takes in completion of the project long time. It may be 3 years, 4 years, 5 years, 10 years. So if you are a developer company, then revenue recognition has to be as per the percentage of completion method, and accordingly the reporting has to be done. But I mean, if there is any other question or any other point you want to discuss so far as this aspect is concerned, it is not clear coming out from the question.
Absolutely.
So, friends, we have given all answers which people have asked. Few things are there which somebody has send me a comments. Now, this Benami, no doubt, there are so many changes. RKG has very rightly summarized this diversion of fund, financial health, okay, and the asset quality and the bank's loan which are taking place. No doubt, if you see the corporate fraud which has taken place, or you see the insolvency cases, you will find that all these issues which Karo is addressing, that is the outcome of these frauds and these siphoning of funds and the related party transaction. I have seen in some of the cases where they have taken a loan from the bank, and there was no system to tell that which bank, how much they have taken. So what is happening? There was a system that suppose you have taken 70 crore loan, and the highest loan from one bank was 8 crore. So you are getting a confirmation from that bank that 8 crore loan is there, and other bank, and you are showing only 30 crore loan. So 8 crore is covered, 4 crore is covered of other bank. Everybody is thinking, okay, my loan is 8 crore is covered, and people were doing manipulation. This has come in so many fraud cases. If you see the CBI report and the ED report, you will find this, that these people are doing like this. So now the most important thing which Karo has done, that they have formatized the entire thing. Not they are saying that you have to give information. They are saying you have to give description of property, gross carrying value, held in the name, whether promoter, director. So the violation, there should not be any chance of manipulation. Now, revaluation reserve, revaluation of property, that is another things people were doing at any time, any moment for their benefit. Then Benami is there. Bank loan, I have told you. The working capital, you have taken advance, you have given advance, you are borrowing, stock issues there. And then the most important thing, contingent liability. People were mentioning that they are writing a letter to the authority and then saying this is dispute. So now they have clearly mentioned that dispute means no representation, but it has to be filed in the particular regulatory body. So they have tried to plug for so many things. But my point is, there is a multiple, like auditor is giving, CARO report is coming, secretarial auditor report is coming, and then cost accountant report is coming. So my suggestion is, they can make a consolidated thing and they can divide into things, so there should not be overlapping. And that is one part. Second is, CARO is now implementable from first. So people were confused that from first I have to follow. No, and correct me, all the speakers, that CARO you have to report from last year's entire thing. When I'm reporting for last year.
Last year is current year.
Last year.
First March has not yet come.
So do you think that suppose something has done in 2021 and something has done in 1920 and 2021, I have to take care of this also in this CARO report?
See, as per our accounting standards, events occurring after the balance sheet date or even prior period items, if they are significant, if they are material, we have to consider those also. So those are both forward and backward, both are relevant, if provided they are material and see if they are relevant.
Okay. Now, as a ritual, we are always asking, before closing the program, we are asking the comments of the all speakers. That now the law is there. Law will be implemented. Law queries you have tried to solve, and other things people can talk to us and they can solve. Now, what is your call on this new CARO? How this will change the business, how it will affect professional, how the role of auditor will change. So in 1 minute, everybody can quickly tell your comments that life after.
Yeah. My first comment is that over a period, auditors has seen their, they were preparing their audit reports like cut and paste. They were just changing the date. That practice cannot now continue when they are going to issue report after 1st April 2021. Now they have to, each and every aspect has to be verified. Now they cannot say they don't know they don't have information. Company itself is giving all that information, and they have to perform additional audit procedures on that, and then they have to give their report seriously.
Okay, R.K. Agarwal ji.
These increase in regulatory requirement, particularly in CARO reporting, should not be viewed as if compliance burden has increased. As generally we see that people complain that government is increasing compliance burden day by day. No, it is for the good of the company and its financial health and its future. This is for the purpose of giving the early signals if anything wrong is going into the company. Because I just give one example, diversion of working capital, short-term funds for the long-term purpose. It is such a bad practice. और जनरली अच्छी से अच्छी कंपनियां करती हैं विदाउट एनी इंटेंशन. उनको मालूम ही नहीं होता कि हमने ये गलत कर लिया, लेकिन उसका जो नेगेटिव इम्पैक्ट है वो कई 2-3 सालों के बाद मालूम पड़ता है. लेकिन अब वो अर्ली रिपोर्टिंग की वजह से उनको आज ही मालूम पड़ जाएगा कि भाई ये गलत है. तो जो फाइनेंशियल डिसिप्लिन के प्रिंसिपल्स हैं उन्हीं को इनमें इनकॉर्पोरेट करके उसकी रिपोर्टिंग है. एंड मैनेजमेंट शुड ऑल्सो टेक दिस रिपोर्टिंग सीरियसली and try to rectify whatever the adverse comments are there.
Okay, Amit.
So while on one hand, the companies have to change their attitude towards compliances and ensuring the transparency, it is a burden on the auditor as well, and even the compliance team of the company to ensure that they don't miss out, because now the consequences are very heavy. If you fail to report anything and tomorrow the consequences are following, then the professional will also be equally responsible. So I think a very, very big message for the professionals also to take care of necessary reporting, because you can't, as Anil sir was rightly mentioning, that you have to consider all the aspects while doing the reporting. So I think we have to be extra careful. It can't be just be a tick box exercise or copy paste exercise.
Okay, thank you very much, Amit. Thank you, Anil ji. Thank you, Rajkumar ji. आप सारे लोग तो expert हो, और the best part is the way lucidly and the effortlessly you people are giving answer. I am requesting all participants, any question is unanswered, please call us, please send a query to us, and we will take the help of Anil ji, Rajkumar ji and Amit to give the reply. We have received all the questions, we have tried to give answer. I think one question has come, which I will just, I'm asking, there is an audit committee, such mechanism. I think this answer we have given, okay? So he has repeated the question. So thank you very much. And I hope that the new CARO report will change the face of Indian corporate. This will be change the working style of the auditor also. The point is that glass is half empty and half full is nowhere in picture now. If this glass is half empty, you have to write half empty. If glass is half full, you have to write half full. Otherwise, what we were doing, I have to write half full. So we will talking about the full glass, not the talking about the half empty portion. So now with this formatization, I hope that this problem will go away, and hope that good governance practice and the CARO will help in this, and all auditors will be geared up to this. With this thing, I thanks all my learned speaker, Anil ji. No doubt we have called you after 81st program, but be part of this. And it is a mistake of not me. It is another founder of corporate, Rakesh Rajkumar ji has suggested me your name today.
But out of 81 programs, the topics relevant to Anil ji were less than 10.
Okay. So we will do it and continue to our journey for doing this. Next Friday on 1st, we will have our next program. We will inform you, because some topics very interestingly are coming. which are pressing, and the participants are requesting that in place of general topic, please cover the topic which are essential and which are required. So that's why M&A program we have changed to the CARO program, because that is implementable. Okay.
Let me reveal you one thing, that I have been viewing your program a number of times. Whether you have called me. Yeah, on succession, and I think there was 2 programs at least I remember recently I joined and I attended those programs. And those were really good inputs I received.
Succession में तो मैं ही था अनिल जी.
हाँ, आप भी थे. Yes.
Yes, I was one of the speakers.
So thank you very much to all my participants, my learned speaker. So we will meet you again on next Friday at 4 to 6 to discuss the burning topic and discuss with you the new aspects of Q corporate laws. Thank you very much.
Thank you.
Thank you. Namaskar.
Thank you very much.